Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time, and we're keeping people up very late and keeping people. We're spanning 15 hours of time zone from Singapore to California, with Walter Simpson sitting happily in the middle and not having to stay up late or get up early or whatever the equivalent might be, as we have the luxury of the time spot here. But we've Brent crude oil trading this morning a little bit up, 82.98, basically stuck around that $83 level. Um, Back down through the second quarter now from the highs of 90 plus to in its comfort zone in a way. The average oil price for the year to date has been about $83 Brent, and it seems to be right on that sweet spot now. Is that a ceiling or a floor, that average price of the year? Let's start in California today with Richard DeGoglia, CEO of Matrix Global Holdings. One of my favorite subjects these days, Richard, is that there's no difference between Trump and Biden. And when it comes to tariffs, it certainly feels like Biden is trumping Trump. The tariff war, if you want to call it that, between China and the U.S. certainly making headlines over the last few days, from EVs being quadrupled to 100% over the weekend, and then followed up by further tariffs in the last few days. My question to you is, as this tariff war heats up in the coming months, is that bullish, bearish for oil prices, oil markets? How should we look at it, do you think?
Good question. First off, Trump and Biden are not the same, so they might have a similar policy on tariffs, and I'll
Well, they're
give
the
you
same
that.
age.
Oh, let's not go down the path here now, John. Yeah,
Yeah.
one's well, yeah. Let's not go
One
down that
has
path,
hair,
right?
one doesn't have hair. There you go.
Yes.
There's a difference.
Um, but I don't think so. I think that what is being done on the tariff side is, I think BYD is that's the Chinese company making cars, and the largest EV company in the world. I think it's a preventive measure. I think Trump would probably do the same, in the sense that the last thing that you could allow to do is to have very, very cheap uh, uh, Chinese electric cars end up in the United States. Does that sound similar to Toyota or Datsun or anybody else in the 60s and 70s and 80s with Japanese imports, and which caused a significant amount of movement of all the Japanese companies to build their factories in Georgia and Alabama and all around the country? So I don't know if that's the case. I don't think it affects oil demand. I think the difference is the policies, right? And so Biden's policies are mixed up. They don't really come together. While he put 100% tariff on cars, he still needs the cobalt and all the rare earth metals that China is going to have to give and put in the batteries that these large car companies are having to, as they make the EV mandate. Right, we need to have 75% of all cars they want to be bought in the United States has to be EV. Um, I am really look at this and cannot understand how this could be the case. This is a governments are trying to dictate consumer behavior, and to me, it makes no sense. I don't understand how we can look at this and have to make any sense that the governments are trying to go along this path of saying you need to buy these cars. And so what you really might not have saw was in Biden's speech was you can buy any car, he says. You can buy anything. If you listen to what his speech was, you can buy. You can't. We're going to put 100% tariff to protect the unions, which is really what this is about. Remember, this is about unions. It's not so much about cars. It's about unions, which are the largest voting bloc for the Democrats in the United
I'm
States.
not,
So
I'm
when
not
you
sure. I'm not sure I'm going to let that one pass, because inevitably these are trumping Trump. I don't know if it was unions when Trump did it, was it?
Well, but the Trump, no, same thing. But remember, Trump did it not so much as a function of, and I don't, not a big fan of tariffs myself. I think tariffs and free trade is something we should all look for. The issue though is this having to do with EVs and having to do with the green agenda. What Biden said in his speech was, "I want to protect. You can buy all cars. Everyone can buy any kind of car they want," and that runs directly to a speech that Trump gave in New Jersey on Saturday, which was, We will not tell you what you have to buy. You can buy any car you want to buy, and we're not going to mandate and use the EPA and the DOE to dictate policies for the consumer. So we can get caught up in the language of what is the tariff and who has the bigger tariffs. I tend to think what that does, it hides the policies behind why are they doing this? Why are we seeing these tariffs as it relates to EVs and batteries? And again, I will say it has to do more with the function of pushing the agenda of let's have EVs, but let's also at the same time support US based car companies.
Okay. Well, Abha Gandhi, Pricing Director, Oil Products General Index, sitting in Singapore. You're in today, tomorrow, and Richard's in yesterday in terms of time zones. That's the only reference there. But Abba, I want to come back to the key question, where does this play out? How does China react? One of the big stories since Janet Yellen's recent visit to China has been all about this massive idle extra capacity of manufacturing production in China that the US and the G7 want to sort of reverse or shut in. Your thoughts on the macro impact that this could have, this growing trade war, tariff war between China, the US, China, and Europe that impacts global trade and oil?
Thanks, Sean, for having me. So that's a very interesting question. It is a very interesting year. We are in the year of elections. We have seen the Chinese premier visiting these countries as well, especially in Europe right now. But if you were to just look at China itself, right, their own PMI, their own manufacturing index is looking a little bit better. They are coming out of a contraction that we have seen over the past few months, few years, in fact, since COVID. So that certainly is, their own domestic markets is looking a little bit better. In terms of crude, well, at this point, I think Chinese market is certainly looking a little bit better. What we are from a macro fundamentals looking at, and I look at crude primarily, is that, you have some maintenances coming up. So that's going to sort of, keep maybe crude a little bit more available. But I mean, for me, it is at this point of time, it is very important to just see where the Chinese economy is, and it does look to be doing a little bit better, at least from some of the macro indicators that have come out in the recent days.
Walter Simpson, Managing Director at CCED in Oman. Walter, good morning. We have China still. China purchases much of Oman's crude oil, and China still importing, as of recent figures, 11 million barrels a day. Your thoughts on the outlook as you're at the end of a long piece of string that is OPEC plus oil production and oil supply cuts, if you like. The outlook for the coming decision only in a few weeks away. What does that feel like to you from a sort of supply-demand balance point of view?
Well, good morning, Sean. Good morning, everyone. If you look at the OPEC report that came out around, their predictions on growth, they're still seeing growth in the oil consumption this year. 2 and a bit million barrels, they're seeing growth. It's premised on, continuing growth in the US, recovery in China, etc. But prediction is still growth. So I think we're going to see that the oil prices are going to stay pretty much where they are. I think the 80-85 area is it, and I think we'll start to see that growth. I guess the only little one today that I noticed in the news spread you set out, Chinese, the Asian refineries going away from Saudi crudes because of the premium that are on them. Now, whether that'll be reviewed or not a little bit, I don't know. We'll have to see. But it would seem to me that the market share is what's behind all of this, and they're going to look to defend that. But I don't think that's going to be defended by cutting production. It's going to be making sure competitive pricing is there. So I'm optimistic that we'll keep going where we are at the moment, if I'm honest.
Just to sort of follow up on that, we've had some commentary in recent days from Kazakhstan and from Iraq, and comments that are floating around, and it's the season as we go into OPEC meetings where comments kind of float around and we never know where they're fully anchored. But nonetheless, questions, it's the time for questions. What will OPEC plus do next? Roll over or start to unravel these cuts? I wanted just from a production point of view, because there's also commentary around that the cost of maintaining these cuts for oil producers is quite high. An energy intelligence report the other day saying that there's growing tensions within the OPEC Plus group to start to unravel because the cost burden of maintaining so much idle supply is burdensome. I wanted to get, as a producer yourself, 40,000 plus barrels a day. Is that a significant enough factor to figure into an adjustment of policies? Or your thoughts on that?
The simple answer to your question is yes, it does. Because it clearly, if you've invested your capital and you're not getting a return on it because you're keeping it idle deliberately, that presents a challenge for anybody from a financial perspective. The real question is how big that is, and also what the opinion, and I stress opinion rather than facts because it's all projection, is, what's the benefit? How much has the oil price gone up because of the cuts? And does that compensate you for the production you're keeping cut in? And that's a very difficult one to really put facts on. It's more opinions. So my view is that yes, it will be a factor in the discussions, but I'm not sure as yet it's something that's going to change things. With oil prices where they are, I don't think the industry, the OPEC Plus, is going to be looking to say, oh, we can back off now. Markets are strong enough. There won't be an issue. Just flat out go for production. However, I do see some indicators that are, the little things that sometimes give you an idea what might be going on. And you notice that the majors, and BP announced it, we're backing away from our commitments around going to renewables. What we're going to look at is return. There is nothing provides the same return as oil and gas investments. So, underlying that says we still see oil and gas as being a major return for us into the future. And I think that's going to be the challenge we've got going forward is, are the NOCs and the IOCs going to continue to invest to keep production up? And that'll be depending on what we think demand's going to be. And the indicators to me are at present that everybody thinks demand is going to be up. What are we at? 104 million, 105 million barrels, 100 million barrels this year. We're expecting it to be at the end of the year. So I feel as though it's all, the demand is still going to be there. And the question is, can we meet the supply rather than we'll have excess supply?
Richard, part of that challenge is the price of money and the cost of maintaining idle capacity or maintaining anything on debt financing is of course elevated now because interest rates are at 5+% on the Fed. Every day seems to be a kind of a constant noise from the Fed and its associated commentators as to whether it's now time to pull the lever on going lower and so forth. Your thoughts on the sort of easing cycle, if it comes, it doesn't come, in more comments yesterday by Powell, which seemed to cheer up the NASDAQ, which hit another record.
I think, Sean, you and I said this last month and maybe 3 months ago. I think we both said, and I think I still agree, and I imagine you do, that we will not see a cut. If there's going to be a cut in rates, it's going to be political, if anything. I don't see any way for the Fed to cut. Prices are going back up again. I think the PPI was 6.2% or 7%. I mean, it was a very high number. So I don't think there's any way that the Fed can reasonably cut, given their mandate. Your point about cost of money is correct. I think that's right. We're seeing, in the Permian, given the fact of associated gas, Walter and I were talking about it earlier, that associated gas is getting crushed because of the high levels of crude production. So the key for the U.S. oil producers has been to a return on people's money, not just to always go out and drill the next well. So that's kind of put a little limit on U.S. oil production. So it's a combination of high interest rates, desire to return capital to the investors, and poor natural gas prices and takeaway capacity. But so I think we're stuck in here. And I think you made a very good point about what are we going to do? This idea of it's a calculator, right? How much does it cost me to shut in a well? And if I come out and say I'm going to raise productions, we're going to see a downdraft pretty quickly. I think if there's any kind of not price war, but an opening up of the taps again, I think the prices will come under pressure. And if I could just take a few minutes here, I went back and looked at a chart. So I went back and looked at. So the price right now is the exact same price it was in October of '83. It was at the end of 2014 for all of 2010. and the breakout at 2007. 07 was the initial breakout to $145, right? So that was the initial breakout. So the price was 83, Brent was 82.50 at all of those points in times. Within 6 months to a year, the price had moved $40 from that price in all of those instances. So the question I have is, we talk about the market right now, but what I think we should be looking at is analyzing what were the dynamics of all of those situations and how do those dynamics change from the situation we have now? And I think there are three things or two major things. One was prior to 2018 was OPEC, was Saudi Arabia, right before OPEC plus. So it's always it was OPEC kind of in the way, right? So in 07, it was China demand causing the prices to rise. In 2010, we saw the increase in coming out of the collapse and the market started to rally again. In 2014, we saw Saudi say, enough of this US production, we're going to put a hammer to it. And they brought the price down from $120 down to 120 down to 20. And then from 2018, we saw the price decline. And then if you remember, on March 3rd of 2020, the Saudis went to Russia and said, you're cheating. And we're going to open the flaps, open the floodgates again. And that caused the price to go down again. Do we have that situation now? And I think this time is different. And this time is different because we are now fully into the energy transition. And OPEC Plus is being told, we do not want your oil 10 years from now. We don't want it now, but we don't want it 10 years from now. So, and Walter made a very good point. I think Walter's point was well taken in that we're just now seeing BP and Shell say, you know what? This renewable thing's not working too well for our shareholders. Let's shift. Well, that's going to take time. Exxon and Chevron have already done it. That's going to take time. So upstream and
Exxon and Chevron never changed in the first place.
Correct.
Ava, I wanted to just pick up on the point that was made a little earlier by Walter, which is the weak Asia refining margins, which are now at 7-month lows, and seeing essentially a swing away from the Saudi and the Gulf crudes because of the margins are less from processing Middle East crude than maybe other. Is there an other? Is the Americas? Who's the winner here? Or do we end up with just less consumption, less imports, maybe more drawdown from inventories? What's the impact on lower refining margins in Asia on the purchase and consumption of oil?
So that's a very good question. I think truly enough, the Asian refining margins have remained under pressure, especially gas oil and gasoline. Key products haven't performed very well. They're in fact sitting in the very low $10, $12, $13, which is very unlike for a product to sit at that level, especially at this time of the year. I do think certainly the OSPs for June have been higher by the Middle East producers. So what has also happened is we've seen the Brent Dubai EFS narrow so much that now we're seeing the cargoes coming in, a lot of the American cargoes coming into Asia. So that should probably help the refiners a little bit. I'm also not all doom and gloom. We are at the start of the summer season. We should see typically demand picking up. Travel does tend to pick up at this time of the year. It's just that we've seen a lot of flow of product here, and also partially the products have been sitting here because the European refineries were in maintenance. So they're going to come back. So we may see some of that trade flow again picking up as well. India is in elections right now. So perhaps once it comes out of elections, we would probably see a little bit more consumption coming up as well. Although that might be a little bit weather determined and monsoon season determined, etc. But I at this point, I don't think there's a winner, but I certainly agree that the flows from the West have been there. The ARBs have been very supportive. And that's just primarily because what you are essentially seeing is you don't have enough medium sours. I had said this previously also. There isn't just enough medium sours. There's way too much of lighter grades that are coming into the markets, especially into Asia. So what we're actually right now seeing is just better, like medium sweet grades coming into Asia as well. So that should support your margins a little bit more. But yes, indeed, the OSPs have moved higher from last month to next month. So yeah.
Walter, just picking up on your earlier comments on that we've spent the first quarter going up $15 a barrel, 555 each month, and then we've spent the last month and a half coming down for that 5 and then 5 more, sort of an early down $10 from the high in early April. Your thoughts and share. Obviously, you said you feel like that's done now. We're it's going to stop going down. I'm just wondering your thoughts on why that stops going down to, let's say, if the trend of the first quarter was 75 to 90 plus, and now we're retreating back down that mountain, why we're not going to go all the way back down to 75?
Well, I wish I could be absolutely certain about that, Sean. Of course, I can't. But I
Yeah.
look at it from the perspective, there's been quite a few geopolitical shocks gone into the market, and it hasn't. Some of them you would have expected a much more dramatic move in price for some of them. The major shipping routes being affected didn't seem to affect the oil price very much. The troubles in Ukraine, the troubles in Gaza are almost, that sort of stuff goes on. That doesn't seem to have moved it as much as I might have expected in a different time period. So I look at average for the year today. I think 82 and a bit is something like that is the oil price we've seen in Oman as an average so far for the year. That's pretty strong actually, and I feel as though that kind of range, the 80 to 85, is what we'll see for the remainder of the year. Particularly, if the economies are staying where they are, if China is recovering, the growth continues, I don't see why that would change personally. And I think it's the range that OPEC Plus are after, and I think they'll be happy with those numbers. So that's behind my thinking. I wish I had a crystal ball and could tell you it's going to be right, but yeah, that's behind my thinking.
Well, there's certainly pillars in. I mean, you're obviously selling your crude in, they're trading into the second half of the year now. Contracts are July, August delivery and so forth. Do you see anything out from China, biggest customer, anything out on the horizon that indicates that things would soften in any way?
Not at the moment, no.
Okay, well, let's go to the survey question and see if there's a source of softening or hardening from this growing trade tariff war between China and the US. What impact will growing trade tariff war between China and the US have on oil prices over the medium term, 6 to 12 months? Bullish, bearish, little impact. The idea that trade wars of this nature discourage investment, discourage FDI into China, discourage manufacturing. Perhaps, as I said to my wife the other day, there'll be a lot of cheap EVs being dumped in the UAE, maybe because America doesn't want them. We better go out and buy one. Maybe it's finally time.
Buy two.
Buy two, exactly. One for everyone in the family. So this is a growing trade war. Clearly, Biden or Trump wins. This is one thing, it seems, across the aisle, as they say in the US. Everybody seems to be in agreement on beat up on China, and that is only growing. Trump started this sort of trajectory of protectionism. Biden's doubled down on it. Clearly, this is going to be a consistent outlook regardless of election results, and this is a big window of time thing. New energy technologies, etc. So what is the impact on the sort of medium horizon, 6 to 12 months? Bullish, bearish, little impact. Richard, looking out, of course, into the year ahead, been a turbulent period. We still have the horrific events in Gaza going on, and the American elections sort of revving up into sort of near full stride. What's the outlook, you think, US-wise? Economy still going well? It will remain a pillar of oil demand through the second half of the year. Your thoughts where the intersection of the election and US economic health and energy demand goes in the second half?
I think very good question. I think its energy demand is staying very robust. In fact, what we're really seeing energy demand really show significant changes is on the power side. Georgia Power came out the other day and said it's increasing its 7-year forecast from increasing its new supply from 400 megawatts to 30,000 megawatts of new power needed. Same thing in Alabama. So the South is seeing a huge amount of demand for new power. And I think really what that's, to me, it kind of gets me almost, I tend to be skeptical of the rising equity markets, but maybe we're looking at it, this kind of resurgence of AI and productivity. Maybe this is a huge productivity boom that we're in the face of. And I think the U.S., for all its warts, is the epicenter for productivity. I mean, it's a lot of good things come from the United States, and I think that's really what we're seeing. So I think demand is going to stay very, very steady, led by technology. Right, I think it's almost a technology-led rally which really runs counter to how do you provide power, right? What is the way do you provide power? Nuclear power, natural gas power. And really what the biggest issue that we're facing here in the United States is transmission. It's how are you going to get power from point A to point B on a renewable, from a renewables perspective. I think the point that we should look at, and you kind of are heading towards it, is that we should look at the next election, not so much at how it affects tariffs, but how it affects the green agenda. I think what we're going to see if Trump, he looks like he's ahead right now, who knows? But it looks like if Trump wins, I think we're going to see a retrenchment of vast proportions on the green agenda. I think that is going to be the number one thing to look at, and I think it's twofold.
Will that equal ultimately just let China win it? We don't care. I mean, Trump typically doesn't like to lose stuff. China's so far ahead on this area. It's okay, forget about it.
Well, it's one thing to go do that, but the question is how many electric vehicles actually get built. I live in California, where everyone buys that's where the most electric cars are bought, in the country by far, and we are peaking. People are now getting to the point where I'm on the 405 freeway going south on a Sunday afternoon, and there's bumper to bumper traffic, and 1 in 40 cars is electric, or 1 in 20 cars. If half of those cars are electric, there is an issue. So I think that's the one issue. The second issue is, I think, where it's important, and I think this really goes towards OPEC Plus. If Trump gets into power, what happens to the oil patch? Do we actually see a letting go of things? So to me, the number one, the biggest mistake that Biden has made is the LNG export ban. To me, that is inconceivable. Why would you stop LNG, do damage to your domestic natural gas, do damage to your allies at the same time? So I think what we should be looking for going forward, not just in the U.S., but everywhere, do the voters reject the plan? Does higher energy prices across the world in power, all of these things, does it affect how people vote? And if they vote a certain way, is it Maloney? Is it Malou? Is it Oban? Is it Trump? Are all these people going to push back? Is it the Netherlands? Are they going to be pushing back on this agenda? And does that cause a change in how money is going to get spent?
Abha, another election, of course, going on at the moment, the biggest in the world, is in India, where we're seeing actually oil demand increase by 5% in the first 4 months of this year, driven by consumers rather than industry. Your thoughts on the outlook of the election there and its bearing for the performance of India and energy demand in the second half?
I think India is at a very interesting cusp. Indeed, I think it is mostly consumer driven at this point of time, or so it seems. We are a very young population. The country is a very young population. There is rising aspirations. There is still a rising middle class in the country. The results are now just a couple of weeks away. I don't see any shift in policy depending on who comes into power, although it does seem like we could see a third term of the Modi government. But who's to know? At this point, I really don't see a shift in the oil policy, and the oil stand that the country has sort of continued over the past few years under the current government as well.
Walter, last word for you, just picking up a little bit on Richard, but the outlook for oil production capacity. We've seen shale, little impact is the view of this room. We'll put that out on social and see if it concurs. But we saw non-OPEC plus supply grow quite significantly last year, with US in particular adding back to over 13 million barrels a day in record levels never seen in any country previously. But this year, less so. The momentum of US oil production doesn't seem to be carrying through to this year. Your thoughts on why that is, and is that their plateau, and that the growth can come, supply growth can come from our region here confidently and well worth investing in because the US is plateaued? Your thoughts on why the US has plateaued at this time?
Oh, I think Richard answered it earlier. Cost of money. I mean, you're looking at a return on investors, and the shale business is very much reinvesting your capital to keep your production up. Oil prices have helped. The gas is a byproduct. The gas prices have plummeted on the back of that, which again goes to the point about why would you not want to export LNG when you have plans to put a premium on a low gas price? But still, I think that's what's driven it more than anything else. Yeah, there's a bit of capacity and industry limitation in places, but I think it's more money, to be honest with you, and the cost of that capital, and making an astute business about how much capital you can invest in it to grow. Now, in terms of can this region continue to grow production? Absolutely. I don't see any doubt in that at all. But again, it's back to where do you want to invest your money, and how much do you think that's going to get as a return way into the future? You're not looking, you're looking at long-term investments for oil and gas industry. And so you've got to have a view there's going to be a market for that oil or that gas way into the future. Gas, we've got a lot of LNG capacity coming on stream. That's a much harder decision to make around how much you're going to invest in that, because it is capital intensive. Oil, much easier to get the return. And my feeling is, yes, demand is going to continue. And so it is a good investment. And there's certainly plenty of opportunity in this part of the world to fulfill that demand. So I still see it as a good place to invest your money, and a good place to look to do business.
Well, I suppose if we are going into an easing cycle on the price of money with the Fed, even if they're saying, oh, not next month, well, ultimately the next move is downward. Money is going to get cheaper over the medium term, not more expensive. At least that's all the guidance. It's been wrong before. That then perhaps puts a little bit of an engine of opportunity by US oil producers to go back out into the Permian and start drilling again. We'll have to see. But for now, we'll wrap it up there for the day. Brent crude oil trading just a little shy of $83 a barrel, up 0.5% this morning. Thank you, as always. Great to have you back on the show. Walter Simpson in Oman, Richard DeGoglia in California, the Republic of California, and Abha Gandhi in Singapore. Thank you all so much. Lovely to see you guys. And take care. Here every morning, 10:30 UAE time.
Thank you very much.
Cheers, guys.
Cheers.
Cheers. Bye-bye.
Thank you.